All right, let's take a look at some more concepts related to cost, volume, profit analysis. So we've got this question up here at the top of the page. It says the waterfall company sells a product for $150 per unit. The variable cost is $80 per unit. And they give us information about fixed costs of $270,000. So says determine A, break-even point in sales and units. Now we've already done that before. I'm sorry, break-even point in sales units. But we have done that before. And then B, break-even points in sales units if the company desires a target profit of $36,000. Round your answer to the nearest whole number. Okay. So all we have to do here is let's bring this in here. And all we really have to do here to satisfy part A is we're going to have to subtract our variable cost of $80 per unit. Make this a little darker here. To give us a unit contribution margin of $70. And once we do that, we can simply take our fixed costs of $270,000 and then divide that by the $70 contribution margin. Okay, and if we do that, we come up with 857 sales units. All right. So for part B, we're essentially going to do about the same thing. We're going to use this same $70 here. I guess I should probably write what we actually did there. But instead, what we're going to do is we're going to take the $270,000 in fixed costs and we're going to add to that $36,000 in targeted income. Okay, and this is going to come out to, looks like $306,000. And we're just going to divide that by our $70 contribution margin. So let's see what we get here. So if we do that, we have 4,000. Let's see, make sure that's correct here. All right, let's take a look at some more cost, volume, profit analysis type questions. Our first question at the top of the page involves the Waterfall Company, and they sell a product for $150 per unit, and they have variable costs of $80 per unit, and fixed costs are $270,000. It says determine the A, break-even point in sales units, and B, break-even point in sales units if the company desires a target profit of $36,000. Round your answer to the nearest whole dollar. Okay, well, this part A, we've actually already done this before, but we're going to do it again. Okay, so all we have to do here, first step, is we're going to take our $150 sales price minus our $80 in variable cost, and that will give us a $70 unit contribution margin. Okay, make sure that looks like a U. Okay, so $70. We have fixed cost of $270,000. And so this is our equation. So let's see what we come up with. I've already done this, but we're going to do it again. $270,000 in fixed cost divided by our unit contribution margin gives us rounded 3,857 units. Okay. So for B, we have the exact same unit contribution margin as we did before, but our numerator is going to change because we have the same $270,000 in fixed cost, and then we also have our target income of $36,000. Okay, and if we add that together, we're going to come up with $306,000 divided again by the $70 unit contribution margin. So let's see what we get. 306,000 divided by 70 equals 4,371 units, and that is a rounded answer. Okay, 4,371 units if we have a target income of $36,000 given the other facts. All right. Second question is a multiple choice. It says the difference between the current sales revenue and the sales at the break-even point is called the, and you have 4 choices. Okay. Now we have not really looked at price factor. Operating leverage is in your presentation, but we're not quite to that yet. So we have talked about contribution margin and margin of safety. Okay. Our answer here is going to be B, margin of safety. You may recall from the presentation we had a break-even point in our example with the surfboards of 400,000. And then we had estimated sales of 900,000. And we called this $500,000 the safety margin or the margin of safety. Okay, let's see what else we have here. I tell you what, let's go ahead and end this video and we'll come back and do the rest of these in a new video.